to our next panel. This panel is entitled Third-Party Asset Management, and it focuses on insurance companies and their usage of affiliated investment managers and some of the key regulatory implications that are involved, both on a domestic and a global basis, as well as touching on treating large affiliated insurance companies fairly along with third-party clients. Noelle Sproul, one of our survivors of last night's happy hour and wine tasting, is going to be moderating this panel for us. Noelle is a managing director and associate general counsel at Nuveen, and she's also an ACIC fellow. Prior to Nuveen, Noelle practiced with Moore and Van Allen. And so with that, I will turn it over to Noelle.
Thank you, Patty. So welcome to everyone, and thank you for having us today. So as Patty mentioned, I'm at Nuveen, which is a wholly owned subsidiary of TIAA. My background is structured finance, and I focused on structured private placements, including private ABS. I also support Nuveen in documenting and managing the relationships we have with our third-party clients. I'm pleased to have with me today one of my colleagues, Jeff Hall. Jeff is the head of international product at Nuveen. He leads a globally based team responsible for the design and development of investment products across a broad spectrum of traditional and alternative asset classes for Nuveen's multi-channel client base. We are also joined by John Hunt, a partner at Sullivan & Worcester. John regularly represents U.S. and non-U.S. asset managers and their affiliates on regulatory compliance and transactional matters. And finally, our panel includes Michael Renetsky at Lock Lord. Michael has considerable experience counseling clients on securities law compliance, investment matters, investment advisor, investment company, and broker-dealer regulation. That was a lot of investments. So on this panel, as Patty mentioned, we will focus on the global search for AUM and the related regulatory landscape. Jeff will set the groundwork by telling us the process for sourcing a global client. From there, John and Michael will dive into some of the regulatory implications for global expansion, with John focused internationally and Michael focused on ESG and some of the U.S. regulatory considerations for U.S. asset managers that are affiliated with U.S. insurance companies. But before I turn to Jeff to get us started, I wanted to confirm that we have an audience today and start with the polling question. And while that's popping up, I just want to encourage everyone to use the chat and reaction feature to remind us that you're here. Give us a second to get some reactions, and then I'll turn it over to Jeff. So it looks like most folks thinks this goes pretty quickly, with 54% at 1 to 2 months, and 28% at greater than 2 months, and 18% in a miraculous 2 to 4 weeks. So Jeff, I'll let you react to that as you start to think about what the steps and considerations are from a business perspective when sourcing a new global client. Over to you, Jeff. Jeff, you're on mute.
Thanks, Noelle. Well, at first I'm disappointed. I actually just found out I didn't have a chance to vote here. I guess that makes sense given I would have a little bit of a bias. And I think my also reaction is we need to get our foot on the gas so we can actually get some of these clients on board in this 1 to 2 month range that it seems like the majority of our participants are experiencing. So thanks for participating. And I do think it's relevant. This question was framed up under kind of normal market conditions, and as most U.S.-based firms that are trying to build a global business, there's now these times are pretty unique. In some ways, it's easier to connect with clients. In other ways, we're not necessarily getting the face-to-face interaction that investors are looking for when they're engaging with especially with any third-party external manager, especially ones that could be on the other side of an ocean. So the asset management industry is about 65 to 70 trillion of addressable markets, meaning that's how much capital is in play, any type of investor, whether it's institutional wealth, would be looking to hire a manager, across the spectrum of alternative and traditional asset classes. Over half of that 65 trillion is going to come from clients offshore. And according to McKinsey's most recent Growth Cube forecast, their non-U.S. assets are expected to grow at about 3 to 5% on an organic growth rate over the next 5 years, contrasting that in the United States, which is going to be around 1 to 2%. So what does that mean? Naturally, there's a large opportunity for for firms to take advantage of raising capital and building a client base offshore in 2020. But that doesn't come easy, and that's what I'll talk a little bit about today. So being successful globally, from our perspective, first and foremost, it means it's important. You have to be local. So you have to be able to connect with clients. And we view the importance of being local from 3 perspectives. The first is having the operational infrastructure in place. So you actually have, some of the basics in terms of, offices and employees and an ability to actually navigate the local market. The second is regulatory awareness. So that'll obviously resonate and be an important topic that you'll hear more about from this panel this morning. And then the third is the ability to provide superior client service. Being able to speak a local language if needed, understand cultural norms, understand broad sweeping investment preferences. For example, investors from Northern Europe and the Nordic region tend to have a large aversion to leverage. So don't walk into the market trying to sell a 2 or 3 or 4x times levered vehicle for those clients. So those are the 3 main perspectives. You'll notice I left out investment performance, which is obviously going to be a critical part of that equation. But from our perspective, investors are really viewing that as hygiene at this point. So it's the expectation is there that we're delivering. It's more about what are we providing the client service, and do we have the foundation in place to be successful. And so this slide that you're looking at is really 2 perspectives on how we think about connecting with clients. The first is from a product perspective. So if you have a specific product offering, and product has a very broad definition, it could be viewed as an investment strategy. It could be viewed as a distinct wrapper. But that is having an intentionality and understanding and formation of a client qualification list based off of the product that you would be potentially selling. The second is really targeting clients, right? And so that's having a little bit more of a solution approach. It's taking a consultative understanding of what investors are looking for, and then being able to then in turn offer them what they need to solve their solutions. An example that I would think about here that's publicly known at GPIF, one of the world's largest institutional investors out of Japan, just started investing in alternatives about 1.5 years, 2 years ago. So if you were a large cap, LBO, private equity shop, 5 years ago, it wouldn't have made sense to go into GPIF and try to pitch that product. So understanding what what client needs are will help in terms of making sure that you're actually having the right conversations with them. It also matters to understand the types of clients that you're working with. So the schematic up top is breaking up the universe and thinking about, all right, are we talking to tier 1 institutions? Are there sovereign wealth funds? Are they pensions versus wealth investors? And I think with that will come certain levels of customization and it's called versus off-the-shelf product structuring. Which will then impact the life cycle for how we interact with clients, which is on the next slide. Noel, if you wouldn't mind advancing it. And we are, as this is coming up, we think of the life cycle of a global client in 3 phases. The first is raising capital, and that may seem like the most obvious, but that's getting to know it's getting to know the clients. It's going through some of the processes I just described. The second is onboarding them, having them become part of the ecosystem, and we'd like to view that as a partnership. So getting that experience right is critical. And then the third is the ongoing servicing piece, which is, as I mentioned, the critical piece of the overall success. On average, I appreciate the polling question that we had, 1 to 2 months to get a client, fully negotiated and on board. On average, it views us, we think it's about 18 months from the initial point of contact with the client until you're actually converting them from a prospect to call it a fee-paying client where a subscription is made. And so being local is absolutely critical in creating a prospective investor outreach. So you know who you're reaching out to. You're locally compliant with registration needs. Thinking about Europe, for example, you're doing everything that you need to do to be in compliant with MiFID II, AIFMD, and that will put you in a position to then really be able to take the approach that I mentioned earlier, the 2-pronged approach that I mentioned earlier of reaching to clients or actually having product discussions. So once you've established alignment on the product and strategy side, then the clients will naturally start to conduct due diligence. Yeah, Noel, can you pull the slide back up? Is it? We can focus our meetings. That will allow us to focus our meetings around the needs of the client. So it could be at that point is when you're deciding, all right, are we going to offer an SMA? Are we going to offer a commingled fund? What is the client actually looking for? And that negotiation will ultimately determine the level of complexity required. So, for example, a German public pension may require some locally registered manco, such as, for example, would be called a KVG. While insurance companies, corporate pensions, they may have more flexibility in structuring requirements because they have offshore investment companies that allow them to hold certain investments. And so at the end of the day, we see structuring really boiling down to 2 areas of concern. The first is, what is the regulatory capital impact? So then thinking through Europe, insurance company regs, changes, evolution over the last handful of years, Solvency II would be something that comes to mind. And are we structuring products that allow, call it, reg cap, charges to work for investors? And we're even seeing some uptake on the pension side for that. And then naturally, tax is going to be an item that's going to be high on the list, and efficiency and maximizing returns for investors. So I imagine, once it gets to this part of the conversation, this is when we would typically pivot to someone in the audience today to make sure that they're providing the right tax advice to our clients. So some current trends that we're seeing, we have side letters written on this life cycle here, that we are seeing a lot of side letter requests and customized, I'd say, approaches that we probably weren't seeing about 5 years ago. First is on the client reporting side. There typically was some pretty lenient, approaches, especially in private markets. And, on standard, you would deliver client reports in 60 days. We're now seeing the need for client reporting is now getting accelerated in 45 requests for 45 days after quarter end, and maybe even sooner, to the extent investors they have some form of a public entity or they need to report valuations on, which if you rewind the clock back to mid and late March, when there was, I'd say, a fair amount of concern, you could even say panic, occurring with some, investors around how to, handle the volatility in the marketplace. And what did that mean for their private market investments. And, investors were coming to us and now, asking for interperiod valuations. Well, now fast forward that to today, that we're now starting to see some of those, that realization of investors thinking about what they want. Well, that's kind of starting to permeate through, side letter requests. And then finally, probably the other real big trend that we're seeing is side letters that are addressing ESG adherence and reporting. So specifically with investors in Europe, the UK, which maybe in a few months here might not necessarily be part of the the Eurozone proper, and also seeing emerging requests coming out of North Asia in this. So that's something that we're, as a firm, taking really seriously, and also making sure that we're delivering what clients need on that front. So before I pass it to John, there are a few different what we would call delivery vehicles for how we can get our, in particularly private market capabilities, but also to some extent public market capabilities to our clients. And I think of the first two as being transactional. So direct investment, co-investments, these are getting usually single asset types of transactions into the hands of investors, and the manager being able to provide a role with that. This would come with a high degree of customization. Obviously, it's no side letter required because it's going to be really a bilateral, contract and discussion with an understanding with the client. The second two are more, these are commingled fund formations that are typically subject in one way or another to local fund regimes. Typically, it could be in a closed-end fund. You could be relying on 3C7, SEC exemptions. You could also be a registered fund in the U.S. Offshore, obviously, you're talking about any form of UCITS or non-UCIT retail schemes, or LTIFs or other types of structures that are regulated in Europe. And then obviously on open-ended funds, typically what we're doing offshore and where we're seeing the most cross-border activity would be on UCITS fund structures, although there is an uptick in some new kind of cross-border funds that are starting to emerge in Asia that we're keeping an eye on. So I'm going to now hand it over to John, who's going to be able to give you even some more specific insights on offshore regulatory considerations that you can be thinking about the portfolio. But before then, Noelle, are there any questions from the audience or that I can answer?
No questions from the audience, but I want to get John's perspective on one thing you mentioned, which is going into a new jurisdiction and being local. So John, as your clients think about that, what type of analysis do they need to do before they go into that new jurisdiction?
John, you're muted.
You're on mute, John.
Thank you. Jeff had a great summary of how to approach this from a business standpoint, and touched on a number of the regulatory issues that are going to follow through with that. And, I think the first thing you always start is what is the game plan? What kind of products do I have? Who am I going to go? And who is going to be interested, and how am I going to deliver those products? Then from there, depending on the jurisdiction and the type of client, the regulatory landscape is going to unfold. Jeff had mentioned the UCITS directive, for example, and that is a great, that is the European scheme for being able to deliver products to the retail market through a fund structure. He also mentioned the AIFMD, the Alternative Investment Fund Managers Directive, which is essentially the private fund version of the UCITS directive in Europe. And then there's the more general issues about distribution. When it comes to setting up offices locally, and he mentioned the importance of having people on the ground. When it comes to setting up offices, that's going to be driven typically more by local rules rather than by, in Europe at least, these pan-European rules. So again, it's largely going to be driven by kind of who are your investors and where are they located. I also want to note that there are a number of sort of where barriers to entry, and a lot of these can be regulatory as well, making it difficult for U.S. managers to engage offshore clients. In Europe, going back again to Europe, simply because it's one of the largest markets, it used to be fairly easy to do through a concept called reverse solicitation, where the client was reaching out to you rather than you formally sort of engaging the client. Reverse solicitation has been largely made far more difficult in Europe by the AIFMD directive and by the actions being taken by a number of European regulators. Still more customary outside of Europe, but it still exists, and it creates a risk for a U.S. manager who doesn't have a local presence. The other thing that I wanted to mention is that there are a number of regulatory issues that can be solved by third parties. Jeff also mentioned the idea, the need for a manco or a management company. You need one in the context of a UCITS fund as well as an alternative investment fund. Rather than setting up your own manco, having it comply with either the AIFMD directive or MiFID, which is essentially the European equivalent to the Advisors Act and our Securities Exchange Act relating to broker-dealers. There are third parties that can, where you will engage them, they actually turn out to be the manager of whatever the complex is, and then they engage you, the investment manager, to perform the portfolio management, reserving for itself the right to, the obligation to oversee your activities. So going back, it really depends on kind of how you plan to approach it, what kind of clients you want, and where those clients are. And then from there, the whole regulatory scheme will tend to unfold for itself.
So Jeff, back to you for one moment. Talking about going global and the regulatory overlay of each jurisdiction, there's clearly has to be a risk-reward analysis before you decide to enter. Can you talk to us a little bit about how the expansion, the global expansion of Nuveen's business has changed internal policies and procedures? And are there any particular lessons learned that you'd like to share with the audience?
I think, first and foremost, it's important to have a business plan. So understanding what are the costs associated with being in a local market. So are you going to have a local unregistered office? Are you going to have an office that is a rep office? Or are you going to go more deeper and fuller across investment management related registrations, which all those mean different things in different countries, but they each come with them, various layers of expense, both from a ongoing regulatory perspective, but also in terms of creating substance and having employees on the ground that are performing the functions that need to happen. And so then pretty straightforward pro forma P&L that you want to run to make sure that there's the revenue opportunity that exists for building out the business locally is accretive relative to the expenses that it takes to run that business. And I think that what we're finding, and we've actually seen some others in the industry do this, is they jump in with both feet and just assume, all right, we're going to build out a full office. We're going to have all of the substance that the local regulators are requiring, and then only to find out a few years later that perhaps that might not have been the right path. And I think, John even mentioned some scenarios in terms of talking about management company providers, and management company has a need to be operating in some of these local markets, and managers actually have decisions to make. Are you going to do an internally managed entity that you're going to set up and staff up with all of the different functions that that I just referenced, or can you want to hire someone that does this as a really an off-the-shelf service that is called somewhat repeatable. They have scale, and it comes at a different levels. And so there's decisions to be made, and then ultimately once you're actually in the local market, Noelle, obviously at that point, if you are hiring and you have boots on the ground, understanding the functions that those folks are providing, as at some point in time, you can probably count on regulators knocking on the door to ensure that that you do have the substance, that you do have people performing the roles that they're intended to perform, and so that there is that formality of actual procedures that are in place and are actually being also evidenced of activities being performed. So that is something that is we're continuing to build out our business globally, that we're taking seriously, and ensuring that we're addressing as we continue to grow and look at new areas across the globe where there could be fertile opportunities.
Hey, Jeff, Michael, just to echo that, for everyone's benefit, I've definitely had some clients who did have the regulators knocking on their doors when they've got their own manco, and really pressing on those issues around, do they have enough boots on the ground? Is there enough going on in country? Even to the point where I've seen the regulators come right out and tell a UCITS fund manager using an internal manco, you need to switch to an external outsourced manco, and working with the fund then and the fund manager to do that.
Interesting.
And if I could add just
Go ahead, John,
more
sorry.
quick point on that. No, that's fine. One more quick point. The offshore regulators tend to focus a lot more on process. And it is very important that, decisions that you made are documented. In certain cases, especially, Jeff was mentioning a lot of, very sophisticated products that are sometimes newer to a market simply because of the change in a tax law or a change in the appetite. But as these new products come into a market, the regulators aren't necessarily as familiar with them as you may find, for example, here in the US. So in that context, it's very important that you document what decisions are made and why they're making. I think you'll find that they'll work with you, but they certainly want to see that you have thought through this process before you really sort of jump in with both feet.
Important point. Before we turn to the U.S. investors who want to look to non-U.S. managers for the management of their assets, I wanted to provide the first CLE code. So everybody grab a pen or a pencil and write this down. 73429. And I'll repeat. 73429. I'm also going to take this opportunity for another poll before we switch directions. Give it a few minutes to get some, or a few seconds to get some results, to make sure folks are still out there. Though it's encouraging to see the number up on the screen. Got 120 plus people out there. John, did you want to react to those? Or ready for the next question?
Ready for the next one. I mean, it's interesting how many people already are engaging non-US managers. I think that's great.
And then we'll advance to the next question. Oh, sorry. How do you or would you engage a non-US investment manager? Separately managed account only? Collective investment fund only? Either? Or both? Or another option? And there's our results. It looks like folks are open to both SMAs and collective investment funds as well as other options. So John, if a US investor wanted to engage a non-US manager, where would it begin in the process?
Well, to begin, I think institutional investors should conduct the same level of due diligence that they would for a US manager. I can't overstate the importance of good due diligence in the process of engaging any manager, but especially a non-US manager. Next, you can't assume that the regulatory landscape overseas is going to be similar to what it is here in the US. I mean, as a practical matter, there are going to be jurisdictions that are going to have better regulatory environment than others, and more thorough, clearer regulations, and regulators who are more experienced in the securities markets. The big countries, Europe, Canada, Australia, Japan, these are not the countries to worry about. But if you're engaging a manager like from South Africa or from the Middle East, I'm not saying that they're poorly regulated. I'm just saying that the degree of regulation is more of a variable. And I think it's especially important because a lot of institutional managers rely on the quality of the regulation, of the regulator, to determine to what extent it can trust what's going on in that market. The third issue to me is, how does the manager want to, or how does the investor want to engage that manager? And that goes to the last polling question. Do you want to do it as a separately managed account or as a collective investment vehicle? In my experience, most regulation of managers is really about is through the fund structure, that you'll see more fund regulation than necessarily just investment manager regulation. I mean, that's even true here in the United States. So, but how do you want to, and what kind of investment, how do you want to engage them? And they're recognizing too that there are a number of hybrid arrangements. There are things that are funds of one, where essentially you have a fund structure where the asset manager will bring the custodian and administrator and others, but you maintain that as the investor, have more control over the liquidity of that portfolio as well as its composition. So those would be the sort of the three big issues that I would look at if I was starting as a US manager looking abroad.
Do you consider it important for a non-US manager to be registered with the SEC?
I do. I'm not saying that it's required, and for certain jurisdictions, probably less of an issue. But I think U.S. registration has a lot of important benefits for a U.S. institutional manager. I think the first thing it does is it shows a commitment by the manager to the U.S. market. Depending on how the offshore manager is structured, whether they have like a U.S. subsidiary, but a lot of times they'll have either a division or they may just have the entire US entity that's registered. At that point, the whole thing comes under the US jurisdiction. And so, you'll be able to get current information about the manager on the IARD. You'll be able to find out about any kind of disciplinary history or, other kinds of things that in the DRPs that are in the Form 80B. The third part of that is that, you as a manager are going to be more familiar with how that entity, how your relationship is going to be treated. The fiduciary duties, for example, differ around the world. In Europe, they're different than they are in the US. They can even differ among jurisdictions in Europe, notwithstanding the pan-European passport. So, however, if you're dealing with a US registered investment advisor, you know what that fiduciary duty standard's going to apply. Finally, in the context of ERISA investors, it's important that you have a US registered advisor for purposes of certain prohibited transactions exemptions and other things, where it makes it easier to, your liability, your responsibility for that manager is much more understood in the context of a US registered advisor, even if it's a foreign advisor, than a non-US registered advisor.
And so as institutions are thinking about engaging with non-US managers, would the arrangements be documented consistent with the manner in which you would document with a US manager?
For the most part, if you're investing in an offshore fund, you're going to get a subscription agreement. There will be some differences in the agreement, certainly. But by and large, the fund documentation is similar. I think the European, and especially in the private fund space, European documentation is a little bit more standardized, and it has some disclosure that you just wouldn't find in the US. For example, Jeff had mentioned earlier the use of leverage in different portfolios, and under the AIFMD, there's a whole leverage disclosure regime associated with it. So there are certain types of information that you're going to get in Europe as a part of the standard documentation that you wouldn't get here. But by and large, it's the same, and the same with separately managed accounts. You're going to get an investment management agreement. And in some cases, you're going to be able to use your investment management agreement to engage a non-US manager. I will note, though, that there are some differences between US and European documentation. For example, in some European countries, they will have separate fees and separate authority for trading the portfolio, even when the manager has full investment discretion. There are terms that we have in the US and standards that don't exist or are understood differently abroad. For example, the Cayman Islands does not recognize the definition of gross negligence. So if you open up a Cayman PPM or a limited partnership agreement and see gross negligence, there should be some reference to what jurisdiction that applies to, because it won't apply in the Cayman Islands. And the other important part of your relationship is kind of where disputes are going to be settled. It can get very expensive if they have to be settled in, a different jurisdiction, and especially when you're trying to participate in your own defense, having that any kind of litigation conducted in a language other than English can get very expensive and can be very limiting.
Thank you. And John, what other important issues should a U.S. investor be prepared to address when looking global?
It may sound obvious, but you should understand exactly how the portfolio will be invested. there are how we structure securities, certain types of securities, can be different than the way that they would structure them in Europe. For example, an ETF in the US is actually exchange traded on an exchange, whereas in Europe it's an OTC transaction. There are others, especially, for example, in asset-backed securities, can also be structured differently, even though they may be called the same thing. So it's important that you actually understand sort of not only the names of what they're investing in, but whether or not you understand the structure of those investments to make sure that it fits within your own investment guidelines. The other important consideration is examining the documentation that the manager is going to need, especially when the manager is looking for you to have that documentation in place. So for example, if you're dealing with a French manager that's going to be dealing with French banks for purposes of derivative transactions, they're likely going to want a French ISDA. Most American institutional investors don't have French ISDAs. So how is that going to work? Are you going to have to engage French counsel to negotiate that on your behalf? Are they going to be willing to accept, for example, an ISDA under UK law or under New York law? Prime broker agreements, securities lending, and repurchase agreements also kind of fall within that those type of agreements. But those would be the two big issues that I would look at.
Great, thank you. And so, Michael, I want to turn it over to you now. And kind of switch gears a little bit. One thing that asset managers are considering both domestically and globally is ESG. Do you have any advice on how to manage the ever-changing landscape regarding disclosures, including the new ESG disclosure requirements for asset managers in the EU?
Thanks, Noelle. Yes, ESG is a topic that could fill an entire session. So I'll try and sort of limit my comments to some high points here. I think it's useful in answering that to just start, make sure we're all on the same page with terms. Slide 16 notes ESG, environmental, social, and governance. When I first started dealing with ESG issues about 25 years ago, it was generally called socially responsible investing or something like that. So there are a number of different names that are sort of talking about focusing on items and investment decisions that many people would argue are related to things other than performance or investment return. But therein lies something that I think is worth sort of thinking about as we focus on the new EU regulations. And on slide 17, we start to focus in on those in particular. So we've just taking a quick look. We've got basically the EU Sustainable Finance Disclosure Regulation, which will go into effect in March of next year, and then the Taxonomy Regulation, which is going into effect in 22 and 23. These are going to apply to MiFID firms, AIFMs, and UCITS firms. Basically, this is presenting a regime that is disclosure based on the one hand, and also sets up sort of a hierarchy of sorts regarding ESG matters, and then kind of requiring a disclosure of what a manager or the products say regarding ESG. And if we look at slide 18, we focus a bit on those particulars. The real crux, as I said, is one that focuses on the unstated concept that ESG has importance and value in and of itself, and that all managers ought to be speaking to what their different products and what their entities themselves are doing relative to environmental, social, and governance issues as they think about investment. To me, one of the interesting things that sort of points out, and it's probably obvious from the way that I've approached talking about this, is that I think the place from which the EU regulation starts is a bit different from the place where US regulation has traditionally started. And we can see this in longstanding investment advisor regulation, and we can also see this in the Department of Labor's new proposed guidance that came out a couple of months ago, if we can remember what time means in this current period, financial factors in selecting plan investments. And the proposal, which I would argue is somewhat consistent with the way that US investment management regulation has been for years and years, the DOL's proposal tends to focus on their longstanding concept that pecuniary factors are what is important in making investment decisions for plans. The broad investment management regulation under the Securities and Exchange Commission, I would argue, it starts from the same basic tenet. That is, what is the impact on the investment performance of the decision, and starts from that economic perspective, as I would argue is distinct from the EU regulations which are coming into being, which I think it's fair to say begin from the proposition of the inherent value in ESG. We can all have different views on these points, but I think for a US-based investment manager, one of the really important things to keep in mind is this distinction. The US-based investment manager will be governed by the US law even when operating in the EU to a certain extent. And we also don't want to allow attempts to make sure we are doing a good job of complying with the EU regulation to have a negative impact on the way that we'd be viewed under US regulation.
Thanks, Michael. It seems like there's a lot of complexity when you're looking globally. In just a second, I want to turn back to domestic considerations. But before that, get out your pens and pencils, folks, because it's time for the next CLE code. 68154. Again, 68154.
You could see me writing it down because I don't know if I need it as a presenter or not.
I'll send them to you to make sure that you have them. So before we turn to the domestic, I also want to have another poll so that we can get an idea of by AUM how much of client assets are represented by affiliated clients from the audience. Is that poll up?
It's coming.
Okay. Thank you. So by assets under management, what percentage of your client assets are represented by affiliated clients? I know this number has shifted a lot for my institution over the past few years, but something we keep in mind. And here it looks like for the majority, 67%, it's between 50 to 100% are affiliated clients. And 8% of you, it's less than 25%. And 17% are between 25 and 50. And then there's also 8% that all of them are affiliated clients. Clearly, the things that Michael's about to discuss are important to this audience. And one more polling question. By number of clients, what percentage are affiliated? And so here, I think the numbers are pretty similar as to the first question. And so, Michael, I think this turn back to focus on the domestic is important for this audience. So one trend observed for insurance companies is to scale their asset management business to offer investment advisory service to third-party accounts. Can you talk at a high level about some of the applicable laws? Specifically, what steps must registered investment advisors take to ensure that non-affiliated clients are treated fairly?
Thanks, Noelle. And thanks to everybody out there for responding to that poll. I think it reinforced what we assume about the ACIC membership, but it's useful to sort of have that. I would start first, if we can, with common types of affiliated clients. Again, I think sort of establishing definitions or language is useful. As reflected in the polling questions, as I speak, I'm really going to be focusing on insurance company affiliated advisors, and especially ones where there's a significant proportion either of AUM or number of clients which are affiliated. Some things, as you see on slide 22, are pretty simple and straightforward, I think. Affiliated clients obviously include the general accounts, account or accounts if there's multiple insurance companies that are affiliated. That's usually sort of the big behemoth in terms of clients for insurance company affiliated advisors. And frankly, that's usually the one that we need to sort of pay most attention to when we're thinking about issues associated with allocation and all these other things I'm going to talk about. Other ones are pretty straightforward too regarding subsidiaries, but I want to just note on a couple of things. Separate accounts. Those occupy a strange place because they are affiliated. Separate accounts are part of the insurance company. They are not separate in terms of legal entity status. They are the insurance company. However, many times, so focusing on separate accounts which issue variable products primarily, they act much more like third-party clients. That is, the true beneficial owner of those separate accounts is not necessarily an affiliate, but is a third party. So one thing to sort of keep in mind is separate accounts often are going to have characteristics of affiliates and non-affiliates, which makes them even more complex to deal with. Similar thing with ERISA accounts. You may have your affiliated pension plan as a client of the advisor. There are certain affiliate aspects, therefore, due to who the sponsor is of that plan. But similar to separate accounts associated with variable products, the actual beneficiaries of those, particularly if we're talking about defined contribution plan, for example, is going to be someone who's unaffiliated. And so they have aspects of both. Let's move on to slide 23 as we sort of think about the different types of affiliate clients. And really, I want to note here that there are a number, and I'm conscious of time. We're not going to be able to talk too much about a lot of these, but a number of issues that I think are really important, primarily including allocation and custody issues. So we will focus primarily on those as we move on to the next slide and the next question. and you're on mute.
Sorry about that.
That's all right.
So Michael, can you tell us a little bit more about some of the factors that should be considered when investment opportunities are being allocated across multiple clients?
Absolutely. So on slide 24, which is in front of you, I list a number of things which are relevant. I want to focus in on just a couple of what I think are the most important things to think about. First and foremost is that your obligation with respect to any allocation policy and whatever factors you choose to be involved in that allocation policy is to treat clients fair and equitably over time. So fair and equitably over time, and it's all clients being treated fair and equitably over time. Doesn't matter if they're affiliated or unaffiliated, and in fact, the affiliated nature of certain clients, especially if it's combined with those clients being significant in terms of assets under management or numbers of clients, have the potential to put some pressure on this particular point. And one thing that is a constant struggle, and it's fair and okay that it's a constant struggle, it probably should be, but one thing that's useful to look at is always considering what the effect of the policies are that you put in place, the particular factors that you use to determine how to do allocation. And the reason why I say that that's particularly important in this context is that given the makeup of many of your client bases from an assets under management or a number of clients perspective, if one were to put in a simple process of allocation that is based on the assets in each client's account, if your largest client happens to be your general account, and that's 50% of your assets under management, and you are intentionally choosing an approach to allocation that focuses on the amount of assets, the effect of that may be one that ends up being unfair to the unaffiliated clients. So keeping an eye on that, I think, is quite important. The last point that I noted on this slide is one that I think is very important. We keep all of these different factors and things in mind as we look at our allocation approach, but we need to marry that always with disclosure. The more completely we disclose our approach to allocation, the more likely it is that we'll be ultimately judged to have met our obligation of fair and equitable over time.
Great, thank you, Michael. So, and I'm very cognizant of time, but one question that's particularly of interest to me relates to when the asset manager is hired because a particular client is attracted to the affiliated relationship and views an alignment of interest with the parent insurance company. So what should an asset manager do when a client asks that their money be invested alongside the parent?
Yeah, thank you, Noel. And I like to start with the sort of cartoon that's on the slide in front of you. If you can see that, it says for a fair selection, everybody has to take the same exam. Please climb that tree. And that's obviously going to be more challenging for perhaps the elephant than it is for the monkey. I think this is good to sort of just keep in the back of our mind as we think about all of these questions of fairness among affiliates and non-affiliates, and it does relate to that last topic that I was just talking about regarding the effect. You asked, Noel, about the particular situation where clients are coming to the advisor because there is a significant affiliated client or clients, and they want to be investing essentially alongside of them. I find that to be a very common situation, and it's fraught with potential challenges. To me, I think it really comes down to two main things to keep in mind. The first thing that I think needs to be kept in mind is that an investment advisor is always permitted to take direction from its client. That is one thing that's absolutely clear. And in fact, it's your duty. Your client gives you a direction. You must take that direction and act on it unless it's going to violate law. If the reason that clients are coming to you is because you have an affiliated client or clients that they want to be investing alongside, let's work on getting that actually put into some contract language or other language that describes why they are hiring you. That, I think, will go a long way to answering some of the potential issues that could arise around this. And then the second thing, and closely related, again, is going to be disclosure about this situation, not just to the clients that have come to you for that reason, but to all your clients. And for that reason, I tend to recommend that ADV Part 2A is the right place to try to describe some of these things, although it could be in other places. But disclosure among all of your clients that this situation exists, I think, is a second thing that really helps address this. And with that, we're going to leave everybody just wanting to find out more of what I was going to say on these other topics, I suspect, Noah.
You're absolutely right, Michael. But thank you, Michael, Jeff, and John, for this important information. There is more information in the deck on the custody rule and MNPI. And to the extent there are questions, please route them to ACIC, and we'll work on getting answers for you. Thank you all.
Thank you.
Thank you.